You did everything society told you to do. You worked hard, you saved money, you bought a home, and now you're making mortgage payments every single month, like clockwork. But something doesn't feel right. You're paying thousands of dollars a month, and your savings account is barely growing. You check your mortgage balance after a year of payments and think, wait, that number barely moved. You're not crazy, you're not bad with money. The system was designed to work exactly like this. Most homeowners will pay back nearly twice the value of their home by the time their mortgage is done. And almost nobody talks about it. Not your real estate agent, not your lender, not even most financial advisors. Because the people who benefit from you not knowing this are the ones selling you the mortgage. Today, we're pulling back the curtain. We're going to look at exactly where your money is going every single month. We're going to show you the real cost of a 30-year mortgage in actual dollars. And then we're going to give you 3 specific moves you can make, starting this month, to take back control. Whether you've had your mortgage for 2 years or 15 years, this video is going to change how you see your money. Please subscribe to this channel if you are enjoying this content. Let's get into it. Let's start with a word most homeowners have never had explained to them properly: amortization. It sounds complicated. Banks love complicated words. Complicated words keep you from asking questions. But here's what amortization actually means in plain English. When you borrow money for a mortgage, your lender calculates the total interest they want to earn over the life of the loan. Then they structure your payments so that interest gets paid first before you pay down the actual loan. In the beginning of your mortgage, the vast majority of every payment goes straight to the bank as interest. Only a tiny sliver goes toward what you actually owe, your principal balance. As time goes on, that ratio slowly shifts. After many years, more of your payment finally starts going to principal. But by then, you've already paid the bank hundreds of thousands of dollars in pure interest. Think of it like this. Imagine you borrowed $10 from a friend and agreed to pay them back $1 a week for 12 weeks. But your friend says, for the first 8 weeks, your dollar goes entirely to the borrowing fee. Only in weeks 9 through 12 do you actually start paying back the $10. That would feel outrageous with a friend. But that's almost exactly how a 30-year mortgage works. And most homeowners sign up for it without ever seeing the breakdown. Let's look at a real example so this hits home. Suppose you bought a house and took out a $300,000 mortgage at a 7% interest rate. Your monthly payment comes out to roughly $1,996 per month, almost $2,000 every month. Now here's the question. In that very first payment, how much goes toward your loan balance? Take a guess. The answer is $246. $246. Out of nearly $2,000, only $246 reduces what you owe. The other $1,750 goes directly to your lender as interest. That is not a typo. That is how amortization works. And it works this way for years. In fact, it takes over 19 years on a 30-year mortgage before your principal payment finally exceeds your interest payment. For nearly 2 decades, the bank is taking the bigger slice of your monthly check. Now you understand why your balance barely moves in the early years. It's not your fault. It's the math. Let's zoom out and look at the total picture. Because this is where it gets truly eye-opening. We're going back to that $300,000 mortgage at 7% interest. Over 30 years, you will make 360 monthly payments of about $1,996. Let's do the math. 360 payments times $1,996 equals $718,560. You borrowed $300,000. You pay back $718,560. That means you paid $418,560 in interest alone. Over $400,000 just in interest, on top of the home you already bought. Let that sink in for a moment. You paid for your house, and then you paid for it again, and then some. Now you might be thinking, okay, but my home's value goes up over time. Doesn't that offset the interest? Great question. Let's look at that too. Say your $300,000 home appreciates at 3% per year, which is roughly the historical average. After 30 years, your home is worth about $729,000. That sounds amazing on the surface, but you paid $718,000 to live in it over those 30 years. Your actual net gain, when you account for what you paid, is only about $11,000 in real terms. And that's before you factor in property taxes, insurance, maintenance, and repairs. The average homeowner spends 1 to 2% of their home's value per year on maintenance alone. On a $300,000 home, that's $3,000 to $6,000 every single year. Over 30 years, that's another $90,000 to $180,000 out of pocket. Suddenly, the best investment you'll ever make starts to look very different. Now, I'm not saying homeownership is bad, it's not. You have to live somewhere, and there are real benefits to owning. But you deserve to see the full picture. Because when you see the full picture, you make better decisions. And better decisions are what separate families that build wealth from families that just survive. Here's the comparison that will really change your perspective. What if instead of a 30-year mortgage, you had taken a 15-year mortgage on that same $300,000? Your monthly payment goes up from $1,996 to about $2,696. That's $700 more per month. But your total interest paid drops from $418,000 to just $185,000. You save $233,000 in interest. And you own your home free and clear in 15 years instead of 30. That $233,000 you didn't pay in interest could be invested. At a 7% return, that money could grow to over $600,000 by the time you retire. That is the real cost of the 30-year mortgage choice. Not just dollars, but the future those dollars could have built. Now I want to talk about something that trips up even smart people. The difference between home equity and liquid wealth. Most homeowners focus on equity. They watch their home's value go up and feel good. But equity and wealth are not the same thing. Equity is the value of your home minus what you owe on it. It's a number on paper. It exists inside your walls. You can't spend equity. You can't invest equity. You can't use equity to pay your bills. Liquid wealth is different. It's money you can actually access and use. Savings accounts, investment accounts, stocks, bonds, cash, money that can move, money that can grow, money that can protect you. Here's why this matters so much for families in their 30s, 40s, and 50s. This is the season of life where the big financial hits come. A kid needs help with college tuition. A car breaks down and needs replacing. A medical emergency hits with bills insurance doesn't fully cover. A job gets downsized and you need 6 months of runway. In all of these situations, your home equity does nothing for you. You can't call your mortgage company and say, "I've got a lot of equity, can I skip a payment?" You can take out a home equity loan, but that means taking on more debt. More debt with more interest. Digging the hole deeper. The families who navigate life's financial emergencies with grace are the ones with liquid wealth. Not just a valuable house, but actual accessible money. So what's the right balance? Financial experts generally suggest your home should represent no more than 30 to 40% of your total net worth. If your home is 80 or 90% of your net worth, you are house rich and cash poor. And being cash poor is dangerous, no matter how nice your house looks. The goal isn't to pay off your mortgage as fast as humanly possible. The goal is to build total wealth across your home, your investments, and your savings. And the 3 moves I'm about to share with you are designed to do exactly that. Move number 1, extra principal payments. The first move is the simplest, and you can start it this month with no refinancing required. Make extra payments toward your principal. Every extra dollar you put toward principal reduces your balance. A lower balance means less interest charged every single month going forward. It's a guaranteed return equal to your interest rate. If your mortgage rate is 7%, paying extra principal gives you a guaranteed 7% return on that money. You can't find that kind of guaranteed return anywhere else right now. Let's look at the numbers on our $300,000 example. If you add just $200 extra toward principal every month, starting from day 1, you pay off your mortgage 5 years and 3 months early, and you save over $67,000 in interest. $200 a month, $67,000 saved. That's the power of attacking principal early. If you can do $500 extra per month, you pay off almost 9 years early, and you save over $118,000 in interest. Now, here is the most important thing about this strategy. When you make your mortgage payment, you must designate the extra amount as principal only. Log into your lender's website or call them directly. Tell them, this extra payment is to be applied to principal only. If you don't specify, most lenders will apply it as a credit toward your next payment. That does almost nothing to reduce your interest. Principal only. Those 2 words are worth thousands of dollars. Write them down. Remember them. Use them. Move number 2. Mortgage recasting. Move number 2 is one of the most powerful and least talked about tools in personal finance. It's called mortgage recasting, and most homeowners have never even heard of it. Here's how it works. You make a large lump sum payment toward your principal balance. Lenders typically require a minimum of $5,000 to $10,000 for a recast. After that payment, you ask your lender to recast or re-amortize your loan. They recalculate your monthly payment based on your new lower balance. Your interest rate stays the same. Your loan term stays the same. But your monthly payment goes down permanently. This is perfect for families who receive a bonus, a tax refund, an inheritance, or money from selling something. Instead of letting that money sit or get spent, you use it to reduce your mortgage payment for life. Here's a real example. Say you've had your $300,000 mortgage for 5 years. Your balance is now around $283,000. You put $20,000 toward principal and request a recast. Your new balance is $263,000. Your new monthly payment drops by about $133 per month. That's $1,596 per year back in your pocket, forever. And the recast fee? Usually between $150 and $500. A one-time cost. Compare that to refinancing, which involves a credit check, new appraisal, and closing costs of 2 to 5%. On a $280,000 loan, refinancing costs could run $5,600 to $14,000. Recasting is the smarter, cheaper move, especially if your interest rate is already competitive. Ask your lender today if they offer recasting. Not all do, but many do. And if they do, this could be the most valuable phone call you make this year. Move number 3. Invest the difference. Move number 3 is the most powerful long-term strategy for building real family wealth. And it requires a shift in thinking. Most people believe, if I have extra money, I should pay off my mortgage faster. That instinct feels right. Debt is bad. Pay it off. But there's a more sophisticated way to think about this. Your mortgage has an interest rate. Let's say it's 7%. Every extra dollar you put toward your mortgage gives you a guaranteed 7% return. That's good. But is it the best use of that dollar? The S&P 500, a broad index of the 500 largest U.S. companies, has returned an average of about 10% per year over the last 50 years. So the question becomes, do I pay 7% guaranteed, or do I potentially earn 10%? If you invest the difference instead of paying extra on your mortgage, over time you likely come out ahead. Let's run the numbers. Instead of putting $500 extra toward your mortgage every month, you invest that $500 into a low-cost S&P 500 index fund. Over 20 years at a 10% average return, that $500 per month grows to approximately $382,000. That's money outside your home. Liquid, accessible, working for you. If instead you had put that $500 toward your mortgage, yes, you'd save on interest. But that money is locked in equity. You can't touch it without selling or borrowing. Now, this strategy requires discipline. You have to actually invest the money every single month. No exceptions. If the extra money gets spent instead of invested, this strategy fails. It also works best for homeowners with stable income and job security. If your income is unpredictable, focus on extra principal payments first to reduce your required monthly payment. The right move depends on your specific situation, but understanding that you have a choice, that's what gives you power. You are not just a borrower following a script. You are someone who understands the system and can work it in your favor. Let's bring this all together with a simple action plan you can start today. Step 1. Pull up your mortgage statement or log into your lender's website. Find your amortization schedule. If you can't find it, Google your lender's name plus amortization schedule, and it'll walk you through it. Look at your very next payment. See exactly how much goes to interest and how much goes to principal. That number is your motivation. Step 2. Decide which of the 3 moves fits your life right now. If you have $100 to $500 extra per month, start making extra principal payments. If you're expecting a lump sum, research whether your lender offers recasting. If you have stable income and a long time horizon, consider investing the difference instead. Step 3. Automate it. Set up the extra payment or the investment contribution to happen automatically. The biggest enemy of wealth building is forgetting to do it. Automate it once, and then forget about it. Let it work. You don't need to do all 3 moves at once. Pick one. Start this month. Build the habit. Consistency over 5, 10, or 20 years is what separates families who build real wealth from those who don't. Small moves. Consistent action. That is the formula. If this video opened your eyes, you are not alone. Most people go their entire lives making mortgage payments without understanding where that money is actually going. Now you know. And knowing is the first step to doing something about it. If you found this valuable, please hit the subscribe button right now. Every single week, I break down one money concept that your bank, your lender, or your employer never explained. No fluff, no hype, no get-rich-quick schemes. Just the honest truth about how money works, so your family can build real wealth. In the next video, we're going deep on your 401k. Specifically, why the way most people's 401ks are set up is quietly costing them tens of thousands of dollars. It is one of the most important videos I will ever make on this channel. Hit the notification bell so you don't miss it. Thank you for watching.